first, it's time for today's drill down, where we focus on one ETF. Today, we're going to look at the JP Morgan Equity Premium Income ETF, ticker JEPI. This one is really interesting. So it seeks to provide low volatility equity exposure. It also employs a call writing strategy to sort of deliver monthly income. It charges 35 basis points to do that. And if you look at how it stacks up against the S&P 500 over the past year or so, JEPI, it's down about 3% on a total return basis, 2.7%. You look at the S&P 500, for example, again, on a total return basis, the big benchmark is down 18%. So not a bad place to be, and investors have just been throwing money at this product. It actually broke the record for active ETF inflows last year. It took in over $12 billion. That really shattered the previous record that was set by the ARK Innovation ETF, which, again, another ETF we talk about a lot. That clocked in with almost $10 billion in 2022. So just a lot of money coming into JEPI. And actually, Matt, it hasn't seen an outflow since October.
All right, so active, I guess a lot of people saying, is the way to go right now. Joining us now is the person tied to this fund, Hamilton Reiner, head of U.S. equity derivatives at JP Morgan Asset Management. Hamilton, thanks so much for coming in. Yeah, I mean, at the end of 2022, now in the first couple of days, everybody who comes in here says, this is a year you really have to be actively managed. To be fair, I feel like they say that at the end of every year, and it makes sense. But this ETF has really taken the industry by storm. What do you think about active management in 2023?
So I think when people are expecting muted equity market returns, and if you can generate incremental alpha, it's important to be active. Now, I think, unfortunately, people bucket active as one giant universe. The fact is, you have talented active and may not have as talented active. So not everyone is created equal, and I think the idea here is you have to find the people with the right process, the right philosophy from an active perspective to allocate your money to in 2023.
And Hamilton, I'm going to ask you a question I asked to John Davey just 15 minutes ago or so, which is, when you think about 2022, it seemed like everyone was just hunting for income any place they could get it, especially in the equity market. Obviously, JEPI was a big beneficiary of that. But now you have bonds working again. You have bonds that actually yield something. Do you expect that to take some of the wind out of the sails of JEPI?
So it's exciting to say that there's now income and fixed income. So there is now an alternative. But when you think about JEPI, it has a multi-pronged approach to total return. It'll give you some dividends, some options premium, and then some of the upside. And you're doing it with about a third less volatility and beta in the market. So I do think that it still fits in people's portfolios, because when thinking about 2023, markets can be more volatile. And anything you can do to help dampen the volatility of an investor's portfolio will add value. So I think people are going to continue to use it from an income perspective, but we're going to see even more people use it as a more defensive equity allocation as we approach 2023.
And let's talk about some of the equities that you actually hold, because I was trying to find the common denominator here, but if I look at your industry groups, you don't have a single weighting that's above 8%. I see pharmaceuticals, retail, electric in there, insurance as well. I mean, when you're picking stocks to actually hold in this ETF, what does that process look like? What is the common denominator? So
I'm lucky enough to work with a co-PM named Ralph Zingoni, who manages the long portfolio on my behalf and our investors' behalf. And it starts bottoms up, fundamental. We have a very large, well-financed, fundamental analyst team that are incredible. And we look for those stocks that over the medium to long term are very attractively priced. But on top of that, to make it into a JEPI portfolio, it needs to have a more predictable earnings stream. So if you actually look at the commonality among all the stocks, it's probably going to be higher in quality. We're looking for those stocks that are more steady Eddie stocks. They're stocks that if you inherited, someone would say you're just never going to sell them.
All right, I see Apple there at the very top, which makes a lot of sense in that respect. Thanks so much for joining us, Hamilton. Great having you on the program. Hamilton Reiner there of JP Morgan Asset Management. That does it for the first show of the new year, and we missed Eric.
We did miss Eric.
But we'll have him back next week?
Oh, if he comes back from Florida, I think he will be in studio next week, so fingers crossed.
All right, we'll see a little bit more action until then. That does it for Bloomberg ETF IQ. I'm Matt Miller, along with Katie Greifeld. This is Bloomberg.